The first time most first-time buyers talk to a mortgage lender, they're at a significant disadvantage. The lender does this every day, but you've done it 0 times. The lender knows which questions to ask and which ones not to answer directly. You don't always know the difference. The lender has a financial incentive to close your loan at the terms most favorable to their business. You have a financial incentive to get the best possible loan at the lowest possible cost. Those two incentives don't always point in the same direction. This isn't about lenders being dishonest. Most of them aren't. It's about understanding that a mortgage transaction is a negotiation, and walking into any negotiation without knowing what you're negotiating for puts you at a disadvantage before you say a word. Here's how to walk in prepared. When a lender reviews your mortgage application, they're evaluating 4 things: income, assets, credit, and the property. Understanding what they're looking for in each category tells you what to prepare, what to protect, and where your negotiating position is strongest. Income is evaluated for stability and sufficiency. Lenders want to see 2 years of consistent income history through tax returns and W-2s. If you're salaried, this is straightforward. If you're self-employed, a contractor, or have variable income from bonuses or commissions, the documentation requirements are more complex. Lenders typically average your last 2 years of net income from tax returns, which means a good year followed by a bad year produces a number that's lower than your current earning rate. If your income has been growing, some lenders can use a 12-month average with additional documentation. Ask specifically what income calculation method they use before you assume a number. Assets are evaluated for down payment sourcing, reserves, and overall financial stability. Every dollar in your accounts needs to be sourced and documented for the 60 to 90 days before your application. Large unexplained deposits will be questioned. Money gifted by family members requires a gift letter. Money moved between your own accounts needs to be traceable. Start organizing your bank statements now, before you apply. Credit is evaluated across 3 bureaus. Your mortgage rate is determined by the middle score of the 3, not the highest or an average. You know your 3 bureau scores before your first lender conversation. This tells you exactly which tier you're in and what rate range to expect before the lender quotes you one. The property is evaluated through the appraisal, which happens after you're under contract. This is the one factor you can't fully control in advance, but knowing that the lender needs the appraisal to come in at or above the purchase price and that a low appraisal gives you leverage to renegotiate or exit is important context. These are the specific questions that separate informed buyers from buyers who accept the first offer they receive. What is the interest rate, and is it locked? A quoted rate is not a committed rate until it's locked in writing. Rates change daily. A rate quoted in conversation means nothing. A rate lock in writing specifying the rate, the lock period, and the cost of the lock is what protects you. Ask specifically when you can lock and what it costs. What is the annual percentage rate? The APR is different from the interest rate. It includes the rate plus lender fees, expressed as an annual percentage, making it a more complete picture of the loan's total cost. 2 lenders quoting the same rate can have very different APRs if their fees differ. Compare APR across lenders, not just rate. What are all the lender fees? The origination fee, underwriting fee, processing fee, and any other lender-specific charges should all appear on your loan estimate, which the lender is required to provide within 3 business days of your application. Get a loan estimate from every lender you're considering and compare the fee columns line by line. What loan products am I eligible for? Don't let a lender decide your loan product for you without explaining your options. If you might qualify for USDA, ask about it. If you might qualify for state assistance programs, ask whether the lender is approved to originate them. If you've never served in the military, ask anyway, because spouses and surviving family members sometimes qualify for VA benefits that neither party realizes. How long does your process typically take from application to closing? Timeline matters. If you're under contract with a 30-day close and your lender typically takes 45 days, you have a problem before you've started. What happens if the appraisal comes in low? This is a scenario question, not a trick. A lender who can clearly explain your options, renegotiate the price, pay the difference in cash, challenge the appraisal, or exit under the appraisal contingency is a lender who's worked through this before. Vagueness here is a yellow flag. There's a category of information that's available to you as a borrower, but that most lenders won't proactively offer unless you ask. Discount points are never explained unless you ask. A discount point is 1% of the loan amount paid upfront in exchange for a lower interest rate. Whether buying points makes sense depends on how long you plan to keep the loan and whether the upfront cost pays off in reduced interest before you sell or refinance. Ask your lender to show you the break-even calculation on points before you decide. The no closing cost option is rarely volunteered. Most lenders offer the ability to roll closing costs into a slightly higher interest rate, avoiding the upfront cash requirement. This is worth understanding even if you don't use it, because it gives you a reference point for the real cost of closing cost assistance. The float-down option exists at some lenders. If rates drop after you lock, a float-down clause allows you to move to the lower rate without unlocking. Not all lenders offer this, and those who do often charge for it. Just ask. The worst answer is no. Your right to shop for title and settlement services is rarely mentioned. Your lender is required to provide you with a list of approved title and settlement providers, and you have the right to use any of them. Shopping title insurance and settlement services can save several $100s. Most borrowers don't because nobody told them they could. The second credit pull before closing is almost never mentioned up front. Lenders pull your credit again in the days before closing to verify nothing has changed since your initial pull. Most buyers don't know this is happening. It's why financial stability between application and closing is so important. Shopping multiple lenders is one of the highest return activities a first-time buyer can do. Here's how to do it correctly. So you're comparing the same thing across lenders rather than comparing different structures. Apply within a short window. Mortgage credit inquiries within a 14 to 45-day window are typically grouped and counted as a single inquiry on your credit report. Apply to multiple lenders within the same window to minimize the credit impact. Request the loan estimate, not just a verbal quote. The loan estimate is a standardized federal form that all lenders use. It shows the rate, APR, monthly payment breakdown, and all fees in a comparable format. Verbal quotes can be structured in ways that make one lender appear cheaper than they are. The loan estimate removes that ambiguity. Compare on the same loan structure. If you're comparing a 30-year fixed across 3 lenders, make sure all 3 are quoting the same loan amount, down payment percentage, and loan term. A lender who quotes a lower rate on a 15-year loan and a different loan amount isn't giving you a comparable quote. It's best not to make your decision on rate alone. The lender's communication style, responsiveness, and experience with your specific loan product matters. And a lender who is 10 basis points cheaper but consistently unreachable during a complicated transaction is not the better choice. Get a final quote when you're actually ready to lock. Rates move daily. A quote you received 2 weeks ago is not relevant to where rates are today. When you're ready to lock, get fresh quotes from your top 2 lenders and choose based on that day's real numbers. The mortgage conversation doesn't have to be a situation where the lender holds all the information and you hold none. Every question in this video is a question you have the right to ask. Every document mentioned is a document you're entitled to receive. Every comparison strategy is a standard practice that informed buyers use and that nothing in the transaction prohibits. The information asymmetry between a first-time buyer and a mortgage lender is real, but it's closable. You've just closed most of it. Go into that conversation prepared. Ask the questions. Get the loan estimates. Compare the full picture. And don't sign anything that hasn't been explained to your satisfaction. Give this a like if it leveled the playing field for you. Subscribe, and we'll keep handing you the information the industry isn't volunteering.